that is where I stop. We have elaborately discussed four grand themes that we think are a must have in one's portfolio in terms of some facet or the other, right? Directly nahi hoga to indirectly hoga, right? And I'll address it in the Q&A if possible. I'll just take a quick 5 minutes on how we look at portfolio construct, and just to, again, very basic, but since it's so close to our heart, a lot of investors tend to focus on the rate of return. Our idea is, or we equally, one should pay time to the time factor, right? Which is the real compounding machine, which gives that, which is in our hands, right? This is called, the way we classify it is what is in our hands, what is not in our hands. What is in our hands is time, right? The power of time. What is not in our hands as much, right? Is the rate of return. 10% भी grow हो सकता है, 15 भी हो सकता है, 20 भी हो सकता है, 25 भी हो सकता है. There are a lot of factors, external and internal, which will determine that. तो हमारे हाथ में ज्यादा जो है time का, let's focus on that. And why are we saying? Look at this. 25% more time spent, which means instead of 4 years, you allow the stock to be nurtured, right? To grow for 5 years. Let's call it a plant. You allow it to become a proper tree, right? Before you start reaping the fruits in 5 years and not 4 years, right? The compounding machine at 20% will take it to 250, right? Of starting with 100. The same, if you give more time, if you're trying to chase, if you're trying to chase more returns, which is 25% more in the left column. Instead of 20%, we are now trying to target 25%, right? 25% ज्यादा return हम target कर रहे हैं. 4 साल बाद उतना ही मोटा broadly very same आपको returns मिल जाएगा, right? So the broad idea is, instead of trying to chase, let's say 50% more return, right? Instead of 20%, we are trying to chase 30%. We would rather suggest that we focus equal amount of attention to giving that portfolio 50% more time. Instead of 4 years, you will have to be nurtured over 6 years. Instead of 6 years, you will have to be nurtured over 9 years, etc., etc. Obviously, one needs to have a balance, right? Why not have more focus on the returns? What we are saying is, have that balance. Let's not just focus on the return part. Again, just trying to demonstrate that through a stock which is well known, Bajaj Finance, multibagger. We saw it's already 90x in the last 10 years. बहुत cycles देखी हैं इस stock ने, right? Demon, the latest pandemic, etc., right? And you look at the various phases. The compounding has in the last 15 years, right, has been in the range of 40 to 70% per annum, year after year, in the last 15 years, if I break it up into those 3 phases, right? It is obviously backed by similar or more compounding in net profit. Just trying to highlight the power of return, CAGR. When you combine it with time, that's the amount of wealth that can be generated. Again, just trying to highlight a particular stock, and this is again to just to put across our philosophy, thought, etc. As we said, chemicals एक ऐसा sector है जिसने काफी अच्छा किया 10 सालों में. Maybe it doesn't multiply as much. Maybe it's not a 40 to 90x. However, we think it's still a 10 to 20 to as much as a 30x stock by stock, still in the next 10 years. कुछ stock होंगे 10x होंगे, कुछ होंगे 20 होंगे. In some cases, it might also be a 25-30x, right? Therefore, we are very positive on this space. This is a stock just for, again, demonstration. A disclaimer here is that we have in the majority of our portfolios. This is again trying to highlight why we like this space, which is because India is the next under the +1 strategy, where after China, India is seen as the next manufacturing destinations specifically for chemicals. Right, this company is a leader and in the phenol acetone space and downstream derivatives. They have very diversified product portfolio, strong technical skills, and recently, about a year back, the next gen has taken over and We've already seen this stock being a 7x in the last 6 years. We see more growth ahead. So again, just trying to highlight a space that we like. Basic tenets of a portfolio. How do we classify it? It has to have a long-term focus, no short-term. When I say long-term, we are essentially saying 3 to 5 years, right, or more, under our core strategy. Fundamentally driven, goes without saying. Stay focused, right? Bottom-up approach. Very important. Diversification, multi-sector, right? We are of the belief that 20 to 22 stocks. In some cases, maybe slightly more is what our preferred basket would be, right? So 20 plus minus, we would not be in that kind of 5, 7, 10 stocks, right? It doesn't give us the variety or the sector. At the same time, we are not in that camp, which will have 40, 50, 60 stocks. Our preferred comfort zone is 20 to 25 stocks, right? A staggered buying, again, at a 15,800 Nifty, we get asked questions every day. The clear answer to that is stagger your buying, right? And not to try and time the market. This is how a typical portfolio is in our various schemes. All weather would be having around 40% share by weightage, which means these are the likes of the heavyweights, the Asian Paints, the HDFC banks of the world. Right, again, disclaimer, we have that in our portfolios. Here the idea would be the EPS growth is growing 10%, 15%, 20% year after year for the next many years. The next one is business momentum, right? The share could be as much as 30%. Here it could be from the spaces of IT, pharma, chemical, right, etc., etc. Here the expectation is the profit is growing 20% to 30% year after year for the many years. The last is the circle of opportunity where we have as much as 20 to 30% share. Here it could be economy facing stocks, it could be telecom, it could be metal, cement, infra, right, capital goods, right, some of the spaces that, again, the idea here is to have a view which is around 1 year. Business momentum is where we take a view of 1 to 3 years, and all weather is obviously 5 years or more. Put together everything, we get a portfolio EPS growth of 20 to 25%. When you combine that 20% EPS growth with a 5% of re-rating, we get a compounding machine of 25%. At 25%, in 5 years, the money will triple, 3x. That's the first column in the right-hand side chart. If EPS growth is 24% and re-rating is 8%, the money will multiply 4x, right? If the compounding is at 38%, which is out of which 28% is coming from EPS growth, the money will become 5x in 5 years. Okay. Again, just trying to demonstrate where we would put each of these stocks, each of these buckets. All right. Just the thought process, right? So just as an example, something like a Asian Paint stroke HDFC Bank would be in that first bucket where it says, or where we are trying to say that it would be as much as 3x in 5 years, growing at 25% year after year, right? Let's say there is a mid-cap pharma company, right, where the EPS growth is 24%. That would fall in that mid-cap pharma, mid-cap IT, or let's say mid-cap liquor company that we would have. This would have the probability to grow at 4x in 5 years. And the last bucket, as we have seen, and again, a disclaimer, this has happened in the past. We're not trying to say that will definitely happen in the future as well, but it has happened in the past that the likes of Deepak and some of the chemical stocks have delivered 5x in 5 years, or maybe it could be 1 year here or there. That's largely the point we are trying to make.